Today, we're going to talk about what is on every investor's mind, and that is the election and interest rates. So let's just jump right into it. My name's Joe Conroy, certified financial planner with Hartford Retirement Planners. And we've had more and more conversations with clients and potential clients over the last couple of months over what should they do, if anything, with their investments with this election coming up, and it is a highly contested election. So what I want to do is go through some of the conversations that we're having and back it up with charts and facts and figures. If you're like me, you're probably a little bit of a visual learner. So I think all of these stories and the charts will help paint a picture of what we should be doing as we look at our investments in an election year. So let's start out with some of the myths of investing in an election year. Myth number one is that stocks really don't do that well in an election year. As the name would suggest, it is a relative myth. So here's our first chart. Comes to us from information from Bloomberg. Goes back to 1928. This is the S&P 500. So in an election year, as you can see, the average return for a stock market in an election year is 7.5%. How do we compare that with non-election years? It only goes up slightly, 8%, so 0.5% more. So as you can see, the difference between a regular year and a non-election year isn't as big or as wide of a gap as a lot of investors think it is. So here's myth number two when it comes to investing in an election year, and that is if so-and-so wins, the market's going to go down, right? So this is a very contested election. People have very strong opinions, and it is as polarized as I've seen any previous elections, which is saying something because the last few were quite a doozy. But the markets really don't care as much as people think they do about who is in the Oval Office. So if we go back to 1960 and we look at what a post-election stock returns were for the market, and there were only two post-election years where the market was down any meaningful level, and that was in 2000, 2001, and 2008. So if you go back to 2000, 2001, that was the dot-com bubble bursting, Enron, Tyco, and then eventually 9/11. So I think those were really not any kind of factor that had something to do with who was the elected president, but more geopolitical, global economic forces at hand. And same thing at the other down year, which was 2008. That was the housing market crash and the subsequent financial crisis that followed. Again, I don't think we can really blame the president for that. They weren't in control of a lot of those things that went into that event. So outside of that, the market has been flat or it's been up every post-election year going back into the 60s. So we've covered two myths. Now we're going to cover a mistake, and that is a mistake that investors can sometimes make as they go into some level of uncertainty. There's risk in everything that we do in life. It just seems that this is such a large media-covered type of event that is very polarizing. It gets a lot of extra attention, and that starts to bleed into the way that we think about our investments sometimes. So what is the mistake? Well, people going into an election year, this is where the money is flowing. All right, so let me walk you through this chart. On the right, this is a presidential election year. So we're not sure who the president's going to be, and there's going to be lots of commercials on TV and a lot of arguments with neighbors and aunts and uncles and nieces and nephews around the dinner table. But what are investors doing? This is the flows going into equities or stocks. Look how much more is going into safer cash money market type funds. All right. Now, the year after the election, it pretty much flips where we've got money flowing into stocks and not as much money going into cash, CDs, money markets, things of safer nature, right? So everybody's investing conservatively, waiting for the election to go over. I mentioned mistake. How does this really play out? Well, in a video we did, I think back in February, we covered this a little bit, and I think it's worth repeating. We have three different hypothetical options. So an investor has $10,000 that they put in the market at the beginning of an election year, and they just leave it. Investor number two has $10,000, but they don't put it all in. They just invest $1,000 a month for 10 months and then see where things fall. The third investor puts everything into cash and doesn't invest it until after the election is over. Which scenario was the best? So again, we're going back to the 1930s. So this is 23 election cycles. And we have three different scenarios. Which ones did the best? Putting all of your cash in The $10,000 up front, no matter what's going on with the election later on, that was best 14 out of 23 times. The next runner up was putting your money in over time. That was the best scenario 6 out of 23 election cycles. The worst and only 3 out of 23 election cycles was this the best strategy, was going to cash. All right. So as you can see from our chart that I showed earlier, a lot of people are putting money into cash right now, waiting for the uncertainty to fade. But only 3 of the last 23 times did that make financial sense. So what does this mean? Well, if you're already employed and you're actively contributing to investments, maybe through a company retirement plan, or you're doing investing on your own on a systematic basis, keep doing it. If you have money invested, I would strongly urge you to consider to keep it invested. If you have these thoughts that you'd be better off going to cash, just know that the odds are probably stacked against you. And in the past, only 3 out of 23 times did that work out in your favor. So those are 2 myths when it comes to looking at our investments in an election cycle, along with one mistake that we often see people make. So let's switch gears to a very exciting topic, interest rates, right? Exciting for everybody watching, right? Anyway, interest rates do influence a lot of what we do. If you've bought a house, you've noticed that the mortgage rates are not what they were during the COVID times. So just to add a little bit of context, what has happened? Well, there was a lot of money that was circulating. Interest rates were cut down to the bare bones. Money was everywhere. What happened was, due to the imbalance of supply and demand, much more demand, not much supply because of supply chain, inflation ran rampant. And it peaked at 9.1% inflation in June 2022. To give you a perspective, the Fed would like to see inflation at around 2%. All right, so we had some work to do. The Fed raised interest rates to cool off the economy, bring inflation down. Where does inflation sit today? Inflation sits at around 3%. So we're not completely out of the woods, but my goodness, we're in such better shape than we were this time last year. So the current Fed funds rate is about 5.25% to 5.5%. There's speculation and some best guesses from the smartest people on Wall Street that the Fed might cut interest rates starting as early as September. We've been surprised before, so something could change, but that's what the general consensus is. Throughout the rest of the economy, consumer spending remains strong, as well as corporate earnings. I think what we're going to be doing from the last couple of years of fighting higher interest rates is now we're going to be looking to the profitability and earnings for these publicly traded companies that we're invested in. That, in our opinion, will help drive the fundamentals of the market, which usually prices will follow fundamentals, maybe not step to step, but very closely. The last point I'd like to make with interest rates is that as interest rates come down, it does change the flow of investment dollars. So these last however many years, several years, large mega cap US companies and a lot of tech have benefited, a lot of money pouring into large cap stocks. As interest rates come down, that is an environment that typically benefits smaller and mid-sized companies, or small and mid-cap, if you've ever heard us talk about that in meetings. So they have done strong this year, small and mid-cap, so it just further proves the need that we can't exactly anticipate what's going to happen in the market, where in the market is going to be the best place for returns, and reinforces the need for proper diversification. As you get into retirement, the distribution phase, we want several asset classes or places in the market that you're invested to have options to draw money from to meet your income needs. And for somebody that isn't retired yet, that's kind of what you can expect when you get to that point and every day becomes a Saturday. So those are our views here at Hartford Retirement Planners on the election and your investments and interest rates and your investments. Investing is not a one-size-fits-all. So if you have any questions and you're a client, we would love to review your portfolio and the overall financial plan. If you're not a client, we'd love to have a conversation with you and see if we'd be a good fit and if we'd be able to help add value to you. As always, if you have any questions, please feel free to reach out to us, and thank you for watching.